per contract. What'd you get into those at?
Oh man, I got into them cheap. I got into them for 20.
Wow. All right. So I think we're gonna go ahead and get started. I put out a tweet, I believe. I did. Yeah. I'm gonna go ahead and put that out. So if anybody wants to share that, their audiences can hop into here. And we've got about 150 people in, so we'll get started. Yeah, as everyone can hear, our panel's doing really well, especially over these last couple of weeks. And this felt like the opportune timing, I think, to go ahead and discuss how and when to do these option trades because I know a lot of people in the audience are also trying to take these option trades, but there a lot of people are missing, right? They're getting killed on theta. They're just, it feels like you're buying the top on so many different things. So it's like, how and when should we be finding these opportunities? And because we have a three-person panel, I think right now each one of them is going to have time to talk. There might be some more speakers that come in. We'll see. But with that being said, I'm going to turn it over to Juicy first. If you want to lead off, Juicy, with a little bit about just a high level overview on trading options, why you started even trading options, and then just walking us through a bit of your process of how you find the right assets to trade these on, how you go ahead and pick strike dates, stuff like that, and then we'll just do the same down the line.
Yeah, so for me, I have to take you way back, man. I traded penny stocks. I think the majority of people who trade on a short-term basis pretty much starts at the OTC market. And like I said on many podcasts, I've never really had a problem making money. I've always had a problem keeping money, right? But it wasn't until I got hit with a couple pump and dump schemes on these OTCs that I was like, dude, I need to really get away from this. And I started trading options on Apple, right? I didn't know what I was doing. Oh man, I was holding to expiration. Stocks stocks would go against me. I'd just be inside the trades. Um, but I like to tell people straight up, don't look at options as something that you're going to trade. Like options is just a vehicle. You're still trading the underlying asset. You're making your decisions. You're buying sells from whatever stock you're looking at. So in theory, you're still trading that asset. You're just using options as a vehicle. So your focus should be on the buying and selling process, and majority should be on mindset. Because if you don't have the right mindset, you can know how to win and still blow an account, right? So just get that out the way. So for me, I'm primarily a pattern-based trader, right? I'm a pattern-based trader, and I like to use what I call juicy levels, basically zooming out, looking left. I use a lot of pivots. I know a lot of people like the Fibonacci's. I'm not too big of a fan unless I'm at all-time highs with Fibonacci's and I draw extensions. But for the majority of the times, I'm shooting out of what I call pattern-based setup, and I'm shooting towards some form of pivot, and or I'm also playing what's known as an inside bar, which is basically just a setup on a lower time frame. If you look at an inside bar, I can almost guarantee you 8 or 9 out of 10 you'll see a nice wedge that has formed and consolidated on the 5 minute chart. And the next leg, when that high or low gets taken out, that's like a wedge breakdown or a wedge breakout, right? So that's pretty long story short. I'm pretty much just playing patterns on strong relative volume, right? So the next thing is once you have a system, you need to give that system some form of edge, right? What makes your system better than everybody else's? What makes your system have an ability to profit when the market goes sideways? Because in this current market, anybody can make money, right? Anybody can just buy and sell something because everything's going up. But the problem is can you make money when the market goes sideways? And that's where your edge comes in. So for me, I like to play these patterns on what's known as strong relative volume names, names that have at least 2.0, which is 200% relative volume. If everybody's buying, and if I've noticed this, if something has 2.0 relative volume, I use trade ideas to gauge that. Almost always there's a lot of options flow. Almost always there's a bunch of dark pool prints in it. So all that volume's there. At that point, you just need to set up. Now, options. So what do? I primarily trade in the monies, right? And if I can't afford an in the money contract, I just don't trade it. And that's where mindset comes in primarily. So every options chain is going to be different. So Google's options chains can be a little bit crazy, and the spreads can be a little bit wider. So sometimes in these positions, you have to go out of the money. Versus if you're trading something like Apple, where everything's a bit cheaper, the spreads are tighter, I would prefer to go in the money. So in the money basically means, long story short, that the contract's trading at 300. I want to get at the money, I'm sorry, 300 call, right? So closest to that strike as possible in my direction, long story short. So once you find that, I pretty much wait for the market to come to me, either let my level break or let my setup break out, and I'm in with in the money or at the money call, and I'm shooting for one of my pivots on a high relative value name, and I play to scale out, right? So another thing that, and I'm pretty sure a good friend of mine here, exclusive, he's probably gonna go next. He's gonna have this covered. But a big thing you should be doing is playing defense when you're playing offense, right? You should be looking to protect yourself. Once you're up, a certain amount of percent, you should start to scale out and move these stops up just in case it goes against you. Because again, yeah, you're trading the underlying asset, but options, man, I'm telling you, a little bit of a move against you can really wipe out that premium. So once you really want to get to the place where you're at no risk as soon as possible. But that was just like without giving too much of all of the sauce out, short term overview of it.
That was perfect. Great start off, Juicy. And like you mentioned, I think it'd be perfect for X to go next and bounce right off that.
Yeah, no, definitely for sure. Completely agree. So, I have a little bit of a different style than, the traditional professional option trader does. Most, I want to say, institutional option traders that I've met over the years that trade options, they typically stop trading options by 11:30 Eastern, and that's because of the volatility and, things start to taper off. And, which is pretty much true. A lot of option traders usually buy within the first hour and sell after the second. And then, those are the positions that they've taken into Power Hour, where usually they're most likely a profit lotto or an earning lotto or whatever the case may be, and they're waiting for a technical break. So, my success on options has come from playing the short term, securing profits, and using profits to make the next call up. What I mean by that is if you have like I just mentioned on the when I first came in, I had the 2800s, then I had the 2900s, and now I had the 3000s. You know, the $3,000 call options that I have are completely paid with profit. My original investment from the $2,800 calls, I'm not even looking at that money anymore. And as I was telling you earlier, Wolf, that I take my 20% of my profits and I put those into my common stock position. So it's a way to kind of secure your gains and let your profit make more profit, and also secure gains outside of your option account, which is a really good way to manage risk too. Um, but yeah, definitely securing gains on the way up, and you also have to have a plan, when the trade goes against you. So you inevitably have profit takers. Not everybody's just going to ride it and see how high it goes, and you're going to have pullbacks, every few seconds, every few minutes. And, when things start to capitulate, that's where those stop losses can also kind of work against you, which is why I don't really use stop losses until after I've taken profit. And if I'm using a stop loss, it's only because I want to protect the capital that I've already made, but it won't be for 100% of my position. And I use a mental stop loss. I don't use limit orders for those, just because I don't trust slippage, especially on Robinhood as I'm doing this small account challenge. Robinhood is really bad with slippage. So definitely don't recommend stop losses in that regard. I'm just going to let my position ride it out until expiration, especially if it's covered. And what I mean by it being covered is if I've invested 10 grand and I've made 5 grand and I'm up 15 for the whole position, I'm going to scale out and I'm only going to let 5% on the 5 grand on the table. And that can go up and down, sideways. It doesn't really matter because that's house money. I'm not risking my own capital. So, you know, when I hear people talking about, I don't worry. I use a really wide stop loss. You're betting against yourself. A stop loss from the get-go is a good consistent way to protect your capital, but it's also a good way to prevent your position from working. Um, Me in particular, I'm a conviction technical trader. So when I play a Fibonacci golden pocket bounce, I'm looking for that key technical break, and I'm not going to put a stop loss because I 100% believe in my trade and I know it's going to go where I want it to go. And if you're using a 50% stop loss, then just use half the capital and don't have a stop loss. Instead of putting 10 grand into a trade on an option, just put 5 grand and let the position ride. That's the same thing as losing 5 grand on 10 grand, right? So, just managing risk, scaling up, rolling out, and keeping profits, like Juicy said. A lot of the problem with option traders is the ability to retain the profits that they've made. So yeah.
Absolutely. Yeah. And I'm definitely going to dig more into everything that our speakers are saying. So, stick around. This is just kind of an initial overview. We're going to dig a little bit further into picking the actual asset you want to trade on, the strike, and, in the money versus out of the money and all of that. But before we get into that, Knots, would love to go to you.
Yeah, I mean, I totally agree with everything they just said as well. I started doing penny stocks. I did maybe one or two OTC trades before I went to, NASDAQ penny stocks. But, ever since then, I did options and I still go back to penny stocks. Not OTC, but the ones that are listed on NASDAQ and NYSE and all that. But yeah, I mean, they already said a lot. For stops, I truly don't like stops either. That's just my personal opinion. With that in mind, I do use mental stops. I'd rather do that than actually put the order in because when I first started trading, everyone tells you to use stops, and I would use a stop, and within 5 minutes, you may be stopped out of that position only to watch it go up 100, 200, 300%. And it's kind of rough. I've started to notice that, or I've noticed this a while ago at least, using these mental stops and seeing how they react in that area, give or take, a couple of cents. You just have to see how it plays out. Momentum can change in a matter of a second in any trade. And, that's where the stops can really hurt you or, help you. But going into, my options trading, everything I do is technical. Everything I do is on news or just watching for big moves. For example, gap and goes is the trend this week, last week, and probably next week for me. I had Microsoft from around 320, the pre-market high breakout went to 324.80. Google, same thing. Um, I think these trades have really propelled my trading for the better and my account for sure. Um, and I mean, just look at the moves that you have on these. For Google, the contracts that I was looking at and or traded are up over 500% today. So a $20 contract is over, 110 right now. Even if you get, 10, or let's just say you get 100% of that move. That's a big gain for the day. Yeah, you're paying, 2,000 a contract on it, but you get another $20 out of it. You just made, that extra money. It's just crazy the moves that these stocks can do. I prefer to look for big moves rather than, small stocks under 20 or 30. I like to trade Amazon. I like to trade Tesla, Google, Microsoft. I feel like it's best to kind of get a sense of just a few tickers and you kind of learn their patterns. And, that's definitely one. I know a few traders who do that and only trade 4 to 6 tickers. And I can't even tell you, how much I've learned from them and how much, I've seen them grow over time just by doing that. But I just want to give a few points before we go into other things, because they basically talked about everything I was really going to talk to, so I don't want to go over it again. Um, but one of the biggest points I should say is I see a lot of traders, and this is something I did too. So, I'm wrong for it as well. But I see a lot of traders going into these lottos. I see a lot of traders doing weeklies that are really far out of the money. And that's not what you want to do. Like Juicy said, I like to play right near the money or at the money. Um, and if it's a weekly, it's most likely a day trade for me. If it's a swing, I'm usually going a week or two out, preferably even going a month out. And that's just for safety. If the trade doesn't go well that day, you know, it's not going to get theta burned or premium burned, in the end. You still have extra time on it. And I guess I'll stop it for there, and we'll just go into questions and whatever else you have to, go through.
Definitely. Cool. So, Juicy, I'll come back to you. Start off with this. You mentioned typically going in the money. How do you decide whether you're going to go in the money, out of the money? And then the other question I'm going to go with that is, what do you look for in the Greeks? And for anybody who's unfamiliar, the Greeks, you can, I believe, see them on any place where you are trading options, and you'll see things such as theta, vega, delta. and gamma, I believe, are the four that mainly are paid attention to, and theta is your time decay. So essentially, with an option, over time, as you get closer to the expiration date, you are going to lose part of the value due to theta, which is time decay. And the reason that that happens is, let's say for a very simple example, you were buying an option on a stock that was worth $100 and you were betting that it was going to go up to $110. If that stock, because it is not currently over 110, the intrinsic value in it is going to be whatever a certain amount, but there is essentially a period of time, let's say it depends how far you buy out, that it could reach 110. And because of that, you have essentially a time value of money that's baked into your option. But as you get closer, there is a smaller likelihood that you're going to actually be able to hit that mark. So it'll fall and fall. And that's why when you see weeklies, let's say you were trading Tesla, for example, and you were saying, I think it's going to go to 1800. And, that's a massive move. Now, Tesla's been moving a ton. So, those, what's it called? Those $1,800 calls, they may, go up throughout the day as it's moving. But once you go from today into tomorrow, and these are $1,800 weeklies, it's just so much less likely. So they're going to have a massive theta decay and a crush as they get closer to that end date. Now, there's a ton of videos on this on YouTube. There's really good ones. So if you want to get into them, but I'm going to go to Juicy just to what do you look for specifically within in and out of the money and as well as Greeks?
Hey man, I want to say, you just did a great job of an overview of that. So for me, when you go in the money, or I prefer at the money. So I keep saying in the money, I'm sorry. I mean at the money. So that means if the price is 200 for a day trade, I want to trade a 200 call. All right. The reason is when you're at the money, you're pretty much in the money. And those contracts have a very solid delta on them. And that's why they end up costing more. So delta basically tells you how much you're going to make per dollar move of that current of that contract you're in. Okay. So gamma is like an add-on, right? So if the delta is 50 and the gamma is 10, right? So let's say you got 50 delta, you get in at 200 Tesla calls, whatever. Tesla goes to 201. In theory, you should make $50. In theory, right? There's other stuff that comes into play, right? But from 201 to 202, that gamma steps in. Let's say it's 10 cents, $10. You make $60 in theory on that $2 versus that $1. So for me, I almost always prefer to go to at the money contract because I already know that delta is going to be very solid, and if it goes in my favor, I'm going to make money. Now, the biggest reasons why I don't go out of the money is because of how volatile the out of the monies are. So I use stops. I use stops by structure, or when I mean by structure, depending on what I'm getting into a trade. So I call it playing defense by structure or defense by percentage, right? So sometimes I get in, I might have a 12% stop. And I call that defense by percent. So if it goes against me by 12%, it'll automatically cut me out. A lot of times I play defense by structure, meaning I'm saying, look, I'm getting in, and if it hits this level, I'm getting right out of the stop. Okay. But the difference of the move against you with the out of the money contracts, if you guys have traded out of the money, when they go against you, they almost decay a lot of times immediately. You'll be down off a small move against you like 30-40%, and that's very hard for a new trader to be in a trade and not have his emotions come and kick him out of that trade. So I get the in the money contracts in theory, so I can trade longer and I can withstand any moves. So I never really ever go out of the money unless the spreads are really really bad, right? Spreads is basically the difference between the bid and the ask, and sometimes when you go out of the money slightly, you'll see a better spread selection, but that's very rare. Also, another thing you guys got to watch is something called IV, implied volatility, which is basically the stock's future move priced in a way. And if that IV is very high, I pretty much won't touch that either.
Yeah.
Okay.
Sorry.
Yeah, go for it.
Yeah.
Go for it.
I totally agree with the IV, and most of the things with the IV is usually running into earnings. If it's a day before earnings or the day of earnings, IV could be 150%, and that's over average. I mean, average for certain stocks is could be 40, could be 60%, but yeah, you'll mostly see that on large volatility moves or your earnings. And I totally agree with you, Juicy, on playing out of the money. or at the money. Sorry. For example, today Google stock was opened at 27 what 88 27.90. I waited for it to get to around 2,800, and I played really close to the money doing 28.10. So something like that, because Google can move $10 in a matter of a trade, and we saw that this morning. So I totally agree. That's exactly how I play my contracts too. I play right at the money. For example, if we wanted to do Microsoft like I did this morning, the pre-market high I think was 319.06. Off that move, I got 320 calls, which is only 90 cents away. So something like that is what you really want to try to focus on, rather than playing instead of when it breaks out of that 319, going for like 330 calls. You're playing $11 out of the money. Not saying Microsoft can't do it, but it's just you're kind of playing against yourself because you know it premium burns a little more because you're farther out, and the break even if you hold till the end is just not a good area for you. Wolf, you're all set. Sorry about that.
Yeah, no worries. And I'll just go back real quick on a couple more Greek questions to you, Juicy, and then go into UX. So you mentioned the delta there, and I think you briefly explained that the delta is going to be the corresponding move in the stock. And what I recommend is everyone, if you're listening, go ahead and pull up. I think we're kind of using Google here as the example. Go ahead and pull up these Google 2950 weekly calls, and that's what I'll kind of use for this example just to discuss here because that's what our panel's been trading today. And so if you look at these 2950 calls, you'll see the delta is 0.556. And that is meaning that each move within what you just said is, the move within essentially the stock. So every dollar move within the stock would correspond to that size of a move within the
Contract.
option.
Yep.
Right,
Exactly.
Juicy? Within the contract, exactly. Is there a certain level delta that you search for? Do you want to have something that's, some people told me they wouldn't go below a
So
0.4
yeah,
or
so for
something like
me,
that?
if I do, in a rare case, I do out of the money. So there is one case I do grab out of the monies, and that's exclusives very big into this. It's called rolling up. So I made some money on Google. I want to lock in some profits. You know what I mean? I take some of my money out and I take 20% of my profit and I buy $3,000 calls, right? We're not there yet. That's the only time I really will push out of the money contract. And if that happens, I want to see at least 0.35 because there's a lot of times, I'm not sure if anybody in the panel has listened. When I first started trading, the first thing I did was, when I first started trading options, was grab out of the money contracts because they're cheaper, right? It's like, dude, I can put, $20 into this, and if Google moves, I'll make a crap ton of money. But a lot of times, if the delta is not there and Google makes a $10 move, that they won't even budge. And in fact, if it goes down, you pretty much lose it due to theta. So for me, I think you need at least 0.35, about 35-cent move per contract you're going to get in if you get in at the money. But that's why I always recommend you get in at the money because it's going to be at least 50. You don't even have to look at it. It's going to be 50 if it's at the money.
Perfect. All right, exclusive, and go into you. And we're just going to dig through these options so that everyone really, I think we're trying to put on a clinic here almost. Walk me through within volume and open interest in those two categories. What are you searching for when it comes to them?
Um, you know, I don't really like to tell people to focus on volume or open interest because that can be manipulated. Specifically, like I noticed, the other day, Unusual Whales caught one of my buys because I have a large account, and I noticed that he saw me buying those swings on I think it was either Tesla or Google. I'm not sure which one it was, but a lot of these volumes and open interest people that follow those, it kind of leaves you open to interpretation. So I know some people follow them blindly, and that's okay. When you see big money going into a trade, you have to investigate it. You have to see what are they potentially looking at. And in some cases, I've seen people follow them blindly, which works out, and sometimes it loses. So it's kind of a toss-up, 50-50. What I look for And to explain what those are is open interest is the people purchasing them for the first time, and volume is both directions, buying and selling. So, whereas Tesla, yesterday we saw, or Monday and Tuesday we saw 100, 200,000 in volume, but the open interest was only at like 30, 40,000. That's because the people that had them on Monday were selling them yesterday, and the people that were buying them yesterday are starting to sell them today. So the open interest is going to, or OI on the brokers, is what people are first purchasing those contracts. And the volume can also relate to executions. So when people are executing these contracts, it's also going to affect volume. Um, so that's what those mean. But do I particularly look at them? Not really. But when I see something really unusual, I would say, I investigate it and then I look at the chart. And if I see a setup down the line, in that case, I'll probably get something out of the money. If it's, something like a trend line test, which is Google was a perfect example of that, the trend line. Let me pull up my chart here real quick. We had that trend line, right around the 2865 area. So at the open, you see a quick pop, just like you see in the first hour, first 10 minutes to first hour, and then you see a back test of that breakout. 2850 calls would have been perfect for that because that the trend line is potentially going to be tested. And in that case, you can look at possibly getting something slightly out of the money and watching the delta, the gamma, and of course the theta. So, like you just explained, the theta is just for the time decay, and vega is for volatility, which directly affects the implied volatility, and gamma is the multiplication of delta, or in this case, speeding up the volatility in the premium of the contracts. So it's kind of like a multiplication process. When the more volatile a stock is getting in the option side and in the underlying, the quicker these in the money options are going to move, which is why you see out of the money options that are 20 cents, by the time they get in the money, they're, up 3, 4, 5,000%. That's because the delta is increasing. And as it gets closer in the money, gamma and vega are all multiplying, and it's just a big multiplication, and you're just amplifying the premium. So you can get a really large return on your investment out of the money, but your probability of success is far lower. I think it's about typical, I would say in the money options have about 65 to 85% of success, to make profit versus, 20 to 30% on out of the money. So for me, it's all about probability. I do the math and I do it based on probability. So if I have a higher chance to profit on a long term out of the money option, then I'll take it. If it's a little bit higher than the usual, 20 to 30% probability. If it's like a 40% chance, then I'll probably take that out of the money swing. So it also really depends on what the technicals on the charts are saying for me too. So that's really what I look for. But open interest and volume, I could care less.
Got it. Awesome. I'm going to go to
Oh, and there's
UGC
actually
in just a
one more thing
Yeah.
too. If I've seen people fall victim to open interest manipulation. So you have to be careful too when you see, for those who monitor option flow data, when you see an order on something that has almost no volume and they're buying 2, 3,000 contracts, that is 99% of the time is just a pump and dump. That's front running at its finest. When you see unusual volume on something that's not popular, that's somebody setting up their position for it to get ramped up. And then, that's how you get these huge drops when, people start to catch on and everyone gets told to buy this and this and this. And then, that's how people get screwed. So avoid that.
Got it. Appreciate the cautionary tale. Also, I'm watching these $3,000 Google calls, I think with you as well, and they just went up $4,000 a contract while you were talking. It's insane, these movements, and now they just fell a grand, but they're really volatile up here. So we're going to discuss that volatility in just a second, and I'm about to go to Juicy. But real quick, these panelists that are up here are some of the people that I look to every single day for I don't want to say advice, but without calling it financial advice, I would say advice, education, I think is the right word for it. and they're super, super transparent, exclusive, juicy, not safe. You can scroll through their timelines and they're open about what they're investing. I know that they also have premium rooms where they give even more information on that. So listen, these are some of the best that you're going to find to be able to learn about this. And they've, proven it with track records, especially, recently. It's been just off the charts, but I know that they've been doing it for years and years and years. So it takes time to get to the point. Like they didn't just wake up and get really good at this in the last 3 weeks. And they put in a lot of time and effort. So really worth the follow. And if you're enjoying this space, we do a bunch of spaces together. I know Exclusive and Juicy were on a space with me last night. Danny in the crowd, he was there too. We had like 700 people on that for hours. And most of the plays that you're hearing now, this Google play, I think there's a couple others like FedEx and others that hit all-time highs, were all mentioned on that space last night. So these weren't just, winners that were kind of shouted out after they've won. This was transparency. These were people who said, I see this setup. I'm going to go ahead and actually make this trade tomorrow. And then they went and put their money where their mouth is. So again, major props to them for everything that they're doing. And, continue to tune into these spaces. And if you really want to find the easiest way to tune into these spaces, it's again through my free Google Calendar. So if you shoot me your email and just a DM that says you want to be added to the calendar, there's hundreds of people on it now. Probably a lot of you in the audience are on it. I will make it super easy for you to always find these spaces. So you're not finding winners after they've won, but rather you're coming to these spaces and finding them, beforehand and understanding the setups and everything along those lines. With that being said, Juicy, I saw your hand up. I'd love to go to you, and I'd also love for you to talk about volatility.
So I just wanted to agree, man. Open interest, I just learned what that was like about a year ago. And I've been doing this for a long period of time. I do not use it at all. Because I'm playing the underlying, right? Whatever the underlying's doing, that's what I want to play, right? So for me as a short-term guy, I don't really pay attention to the open interest. Now, volatility is my friend as a short-term trader. I love it, right? And when we get really volatile, I want to day trade a lot. So how do you determine if the market is going to be volatile? Well, I like to say that everybody, and Andrew from Pristine Capital does this a lot, you need some type of trend modeling system for the overall market, right? And if you have an uptrend in the overall markets, which I call uptrend, basically means SPYs just keeps making higher highs or Qs are making higher highs, the stocks in that market should be looking to go higher. And if you have a downtrend, you're going lower and sideways trend, you should expect some type of volatility. So when I have a classification of an uptrend or a sideways trend, I'm going to be looking to take gains quicker versus if I have just like a solid uptrend.
Got it. Yeah, that makes sense. And I'm gonna dig into that real quick. I already got several DMs. I need your email if you want to be added to the calendar. Just to asking me to add you to the calendar, I can't do it unless I do have your email. So please do shoot that over as well. Okay, so Juicy, and we have some good questions that are also coming in. I also put out a tweet. I said, what questions do you have about trading options? Go to that tweet. It's my last tweet, and just drop your questions. That way we can take some of them from there and we can give a little bit more information to that. For example, I'm just going to do one of them right now, and then I'll come back to this in a few minutes for the panelists. But somebody asked, I don't understand how I make money even though the stock's price hasn't, this is not great grammar, but basically they were saying, even though the option they bought, let's say in this case, a $3,000 Google option, Google's not at $3,000, but they're still making money as it moves up. The reason for that is because of the time value of money that's still there. Basically, for anyone who's not familiar, just the basic concept, an option gives you the right, but not the obligation to buy, or depending on which side you are on. Let's talk calls real quick. If you're buying a call, that gives you the right, but not the obligation to buy a stock at a specific price. So if I buy a $3,000 call, I'm saying I want the right by X date to buy 100 shares, because options are only traded in sets of 100 at this price. Now, the goal is essentially that I believe the stock will be higher than that. In this case, Google, let's say I think it's gonna be at 3,100. I'm buying an option saying I think it's gonna be, above this 3,000 mark. I will be able to come in, buy 100 shares at 3,000. If I was to technically exercise, most people are not exercising nowadays, but this is the conceptual. And then I could, in practicality, resell them at that moment for 3,100 and make $100 per each contract at 100 contracts, so $10,000. Now, most people are just trading the options back and forth, but the reason why, even though the stock is not above 3,000, the $3,000 calls are going up is because of that there's time left, right? These are weeklies, so there's still tomorrow and the next day. So what's being built in here is the fact that tomorrow and the next day the stock could go up and it could go through a certain price. So there's intrinsic value that's being held within these options, even though right now technically if it was to end right here, the option would be worthless because I would be exercising to buy at a higher price than the stock currently is. So I hope that gives a little bit of information on that. But again, go ahead and drop your questions onto that tweet, and we'll get to more of them as we go through. So I'm just looking right now to see if questions about just how to make money overall are going to be a little bit tough to answer. But oh, here we go. Perfect. This is a great question. Um, I'm going to go to you first, X, and then to Knots. Um, what scanners do you use? Do you follow the flow at all when you're going to trade an option on something like Unusual Whales or Black Box Stocks or Quant Data? Are you using these different services? And then Juicy, I know we'll go to you to talk about kind of chatter quant. But let's talk about services real quick and ways that you can supplement your
So
information.
when you say X, you mean me or exclusive? Because my name's Xavier. Everybody calls me X. I was
Oh,
confused. I
sorry.
was like,
I
wait,
know
what?
you're Xavier, and yeah, I know you're Xavier, and I have friends named Xavier that I call X. I shouldn't say that. Okay, exclusive.
I was just thinking about that the other day. I saw people saying X in the comments on some of these posts, and I was like, I think they're talking to Xavier. I don't know. But yeah, no, so okay, so I'm a partner with Unusual Whales, and I still don't even have the service. Um, and I'm partnered with TradyTix, and I just bought it for our members. So I've really never used it until last month. I think it was mid last month I started using it. And it's cool stuff. It's cool to see the flow of data, but I think it's more of a distraction for me personally. It's more of a distraction because, I'm a day trader, I'm a scalper, I'm a swing trader, but overall with options, I'm a day trader. So, if I'm taking my attention away from, what I'm charting and what I'm trading to look at something else in addition to Twitter, in addition to Discord and stuff like that, it's really more of a distraction for me, but can it be useful to new traders? Absolutely. Because it gives you the ability to look at where money is going towards. But again, just like any other trader, those bets can be incorrect. People make money and people lose money. So, although there may be 100,000 calls in Tesla and there might be 50,000 in puts, you know, eventually one of those people are going to be wrong. So the real question is what side of the data do you want to be on, the side that's correct or the side that's incorrect? So for me, it would personally be more of a tool to analyze after hours, which is what I typically do now. Now that I use some of it, I'll look at a chart, say I'm looking at Google. Now I'm back testing the data from the past 2 weeks or month, and I'm saying, okay, who bought these out of the money options? Who set up? Who was Pelosi? Who knew that it was going to happen? So that's what I use it for, more to confirm if I'm being biased or unbiased. So I use the data to confirm my technical analysis, but I don't use it on a second-to-second basis because it's a distraction for me personally.
That's very fair. Awesome. Appreciate the information there. Knots, do you use any other services?
Yeah, so I'm partnered with TradyTix too. Um, and I agree with exclusive there. But there is great information, across just any service. It doesn't have to be TradyTix, doesn't have to be Black Box or Cheddar Flow. It doesn't have to be any of that. It could be either one. But yeah, I mean, what I try to focus on if I do like something, I do like to, check it out, just dabble around, see what flow has, flown through it. Um, One thing that I have noticed with Traditex and its filters and everything. So for example, one that I've used over the past month and a half, 2 months that I've seen has had so much success. And I mean like these plays were sorry, these flows that are coming through on these names, they've produced like 200, 300,000%. Um, so, oh wait, oh, never mind. Uh, I saw something pop up on my phone. I was wondering what it was. But yeah, these percents these flows have been, nuts. Good example of this is KWeb. So before that big move on, it's a Chinese tech ETF that has like Alibaba, Baidu, and all those. Literally before that move, there was $1 million sweeps bought at the ask or above the ask. So meaning someone is buying them, for full, asking price or market order, and they're getting filled at that. And we're talking millions of dollars here. And literally within days, I watched that position, I think, go from like 50 cents to like $4. And literally, I've been tracking these over the past month. I literally have seen one loser out of maybe 15 to 20 of these trades. And specifically, I'm looking for out of the money calls bought at ask or above ask, and the trades not being spread trades. So these have really worked out. I've actually played about 50% of them now, and I've literally only lost on one. And actually, speaking about that trade right now, it's the ticker MAR. It was November 5th, I think, 160 calls, and that trade is actually up like 50 to 70% now. I sold it for around 15% loss, and it's up around 50 to 60% now. So yes, there is good and bad things about using, some of these things and getting wrong information, because some people may look at, seeing a call, but not knowing if it's a buy or a sell, or, if it was, traded like that. That's why I kind of filter it to have it, show me if it's a call, if it was bought, because, people could be buying or selling these contracts in a different way to, basically sell premium and make money that way. So you just have to know how they're kind of configured and, traded, to kind of really use the service in the correct way. Um, and that's why I kind of filter it in a way so that it's just very simple to use. Other than that, I don't really use much. I kind of just scan for the morning gainers every day, look for news and earnings, and that's pretty simple to me.
Got it. Got it. Awesome. Also, I see a couple questions around some more complex strategies in the comments. So there's, of course, many different ways that you can utilize options. You have your typical calls, which is more of a bullish position where you're saying, I am bullish on this stock. I think it's going to go up. Puts, I think, can be used in multiple different ways. Puts don't necessarily mean that you're bearish on the stock. They're often typically used as an insurance. So you may have a large holding of commons, right, an equity within a stock, and you might say, just in case it was to go down, perhaps on earnings or something like those lines, I'm going to go ahead and buy puts. But then you can also have a number of crushed. I see hands going up. I'm probably saying something wrong. You probably also have looked in and seen that there are some more complex strategies. For example, you can play off of volatility with strangles, and you can have where you're essentially using strategies with multiple combinations of uh, calls and puts, and I really don't recommend diving into that before actually doing the education. So I think somebody asked in the comments what the best book is to read on this, which is a great question, and I tagged Juicy because hopefully he'll have probably a good answer. And also, if my speakers want to go through any of those comments and answer them, that would be awesome. But yeah, just so you know, right now, I'm just trying to give an overview on the basics. I don't think you should be diving into super complex strategies. Listening to what these speakers are saying and finding, great setups, buying at the money or in the money, options, and understanding things like they've been talking about here with the implied volatility and the volume and some other areas. And the Greeks is probably going to be the best initial start, but they all seem to have something to say on what I'm saying here. So I'll throw it over to Juicy first.
Now, let's throw it back to G-Knots. I was just going to explain the scanners and stuff that I use. I think G-Knots wanted to piggyback off something he just said.
Sure.
Okay. Yeah, what I was going to say is what you're kind of just going over. For example, today I'm doing a trade. It's a call credit spread. So basically, I'm kind of just eating theta. I want the contracts to expire worthless, and it's for SPX. I'm selling 45.95 calls, meaning I don't expect SPX to get over 45.95 for me to be 100% profit by the end of the day. It's October 27th expiration, and I'm buying 46.05 call to complete the spread. So you sell the strike that you, let's just say you believe the price will not go over, for the call side at least, for a call credit spread, and you buy the strike to basically complete that trade. So far, that position is up 71% right now, and I expect it to, basically play out full. I don't see ES, which is SPX futures, going over 45.76 today. So it looks like good on that. But you can also play this to the upside too. If you are bullish, or if you think the market's flat, and this is going back to what actually I think Juicy and Exclusive talked about in the beginning, or maybe one of them definitely talked about, if the market's flat or just choppy. This is a good way to utilize, option strategies to your advantage. You can play these spreads to your advantage, especially in choppy markets. This is where, they really, play perfectly. If the market's going to be flat, or if the market's only going in one direction, you can literally use these spreads to, your advantage. And, I usually like to do put credit spreads because, as we have seen, the market, basically just goes up, give or take the dips. And you could do the same thing. So if you believed SPX was going to hold over a certain area, so let's just say, you expect SPX to stay above 45.50 today. You would sell the 45.50 puts, and you would buy, let's just say, the 45.40 puts. And if SPX ends the day over 45.50, you'll be up 100% on that contract, and it automatically sells it for you at the end of the day. Just another strategy to keep in mind. And it's something that I've utilized over the past 6 to 12 months, and it's really, really made a change in my trading. And it's literally one of the best strategies I've honestly ever traded. The probability of winning is really high, especially if you play it pretty safe. I do very safe trades on them. So my probability over the past, let's just say 12 months on these, I probably won about 93 to 95, 94% of the trade. So it's just crazy how well this strategy works if you do it correctly. Other than that, I'll hand it over to someone else.
Yeah, go for it, Exclusive.
Yeah, no, I was just gonna give a recommendation and a little backstory too with a book that I recommend, or two books I should say. So I started trading back in 2011, I think it was. So a few years after the crash, and I started with some savings. I started with 10 grand, lost 60% of it, was down, and I said, okay, hold on, let me take a step back. Let me learn. So that's what led me to learn technicals and options and blah, blah, blah. So one of the first books, and this came out, I think it was about a year and a half into my trading career, or it wasn't a career at the time, but it was Option Volatility and Pricing, and it's by Sheldon Natenberg. And it was a really good book, really good explanation, easy to comprehend, gives you pretty much every angle of options, but also risk analysis related to options. So, and using dynamic hedging and volatility contracts. So it's a really, really good book. And if you want to pair it with another one, Trading Option Greeks, that's one by, I can't think of the author. Let me use handy dandy Google real quick. I remember what the cover looks like, but I can't remember. William J. Brodsky. That's another one that pairs really well with Option Greeks. So if you're looking for books, those are both around the same time frame that I personally used that helped me get to where I got to. So highly recommend those. And if you're not self-educating, that's the biggest thing behind successful traders is self-education.
Perfect. Juicy?
Yeah, so I want to just echo what Exclusives was just saying. I've read both of those books. But something I want to tell you straight up as a new trader, you don't really need to learn a better, because you're going to try different systems. Number one, go on simulation. You're going to try a bunch of different trading systems. What's the trading system? A reason for you to buy and a reason for you to sell. And the way mentor A teaches his system might not work for you. Mentor's B system might work for you better. But the one thing that makes a trader stand out is the mindset. So I highly recommend, it's called Trading in the Zone by Mark Douglas, right? That will probably be the most important book you will ever read in your trading career, because it's all about how you should look at the market, how you should approach the market, how to get, profits on when you're up on the week, how you should be playing defense versus offense, and how you should see your setups, right? But yeah, that's pretty much it for books. Now, going back to what you were saying, softwares and stuff of that nature, everybody said Trading Ticks. I am a big believer in Trading Ticks. I'm also partnered with them. I have their options flow connected to my Discord chat room. Big time believer in the software. I severely think they're severely underfollowed. They need to be bigger than where they are right now. The other thing I use is Trade Ideas, right? So a big portion of people's strategies, like people know how to trade, but sometimes a big missing component is getting in front of the right trade, right? Because they have the system that works, it's profitable, but they're applying it to stocks that aren't moving, and that's why I end up taking a loss. So I use Trade Ideas. I put a picture here. I call this the EUI scan. This basically shows where, and I live stream this every day. So I've combined it a small snippet from one of my screens, so you can see what I'm looking at and what I'm trading. And I combine that with the actual scanner. That way you can just have everything in one place. That's what we call the Eagle Eye. But long story short, this scans for relative volume, options, movers, stuff that's hitting the 20, what has the most volume. A ton of different strategies is included in here, so that way you can find a trade across all markets. But I use Trade Ideas to find trades. I use TrendSpider for technical analysis, and my broker TD Ameritrade, obviously. And I use Trading Ticks to back up a lot of the options, algo flow. They do news. They do, like, Trading Ticks is a one-stop shop, and I highly recommend you guys take a free trial and look at them.
I totally agree.
Definitely.
Trading
I
Ticks
have an
is. Oh, sorry. You go, Wolf. You go.
Are you?
Yeah.
I
Oh,
just
I just wanted to say, I totally agree with Trading Ticks. It's so underfollowed. It's insane. It just gives out so much information. Well, you're all good now.
Yeah, no worries. I actually haven't seen Trading Ticks yet. For anyone that's listening, probably to make it easiest to find them. So is this going to be just, I guess, their Trading Ticks? What's their Twitter?
Trading Ticks. TradyTics.
Got it. Okay, perfect. Something I'll definitely be looking into more myself as well. All right, so we're coming up on the 1 hour point, and we won't run too much longer, but I want to get through some more of these questions. And also just once again, thank our speakers for giving this time. As I'm thinking that they're probably live trading during this, but based on the amount of money that they're making this week, if they, how to take off some time to pay attention to this and to answer these questions, this is probably like, thousands of dollars of opportunity costs for each one of them. So the fact that they're just doing that, for free for us with really, asking for nothing in return, big, deep gratefulness to them. With that being said, just a couple more questions. And that is, do you have any specific names that, you're continuously finding yourself trading options on? They're just some of, the ones that you kind of lean towards. Maybe they have better price action or some other things going on, or is it on a day-to-day basis, you're just kind of rotating and just finding entirely new names? I'll start with you first, Juicy.
I find it to be whatever's hot. If you haven't noticed, a lot of times sectors are hot, right? So tech sectors is what's pretty much everybody's looking at. You got your Google, your Tesla. It depends on, for me, where is the relative value, right? So what's the strength in the overall market right now? We're seeing it today. We're seeing that in Google. So I'm in Google because Google's pushing out like 5.6 relative volume on a name that never really has it. All right. So the best way, in my opinion, to figure that out is something that I do. And here's a tip to you. I take all these sector ETFs and I make a post every now and then. It's called the money flow update. And it has the XLE, the XLF, the XLY, all those names there. And basically it's going to let you know how much that has moved. Is it which one of those sectors is the strongest? And then go inside those names during that day or during that week and focus on the top names in that sector. That's pretty much what I do. I call that working down.
Got it. How about you, Nuts?
Honestly, I think that's great. I think I don't know who said in the beginning, but basically I do the same thing. And also, whoever said in the beginning, I even if it's a red market, I look for the stocks with relative strength and relative volume. So the market may be red, but these stocks are just still strong no matter what. And even in the last dip, 2 to 3 weeks ago, or now a month ago, there was names that would run all week, and usually, those relative strength names usually do run, 2 to 3 days of the week, and that's just another thing you got to look for too. And it's very simple to find that. You literally could just go to, let's just say Finviz, which is you can scan for free, and go to the screener. Look whatever price range you want. Look if you want options, or you know if there's optional stocks, and literally just look up relative volume. Let's just say over one, so over one standard deviation of the relative volume, and just look in the past, or look that day, and see what has more relative volume, what has higher than usual relative volume, and is up for the day and up a lot, or what for the past week, was up a lot and had more relative volume. So yeah, that's just something else you could put in there. I'm trying to think of some tickers that I could go back on and look at right now. I just can't remember. But that's definitely one thing to do for sure.
Got it. Got it. Awesome. All right, I got a couple questions on this, so I'm gonna throw it over to you exclusive, and that is, how do you know when to start scaling out?
When you're making money.
Is there a certain percentage? Is there certain trend
No,
lines?
no, but seriously though, it's also I wanted to turn your attention to Amazon. It's looking more bullish. But no, so what I like to do is I think of it as a unbiased opinion on profit. You know, and I get this question asked a lot too, specifically from our members who are taking my personal trades. And in my opinion, if it's $5, if it's $500,000, profit is profit. No one can go broke from taking profit. So if I'm up, I'm going to at least scale out some of my position. I may not take out 20, 50% of my entire position, but I'm definitely going to take some profit because one, that keeps me motivated. Two, it lets me know the trade's working. And three, it's just more cash for me to spend on some other options that I'm looking to buy. In this case, roll-ups when I'm rolling up to the next strike that's, a little bit further out of the money, etc. So yeah, definitely a firm believer of scaling out at small profits because little by little becomes a lot.
Yeah, yeah, that definitely makes sense. How about you, Juicy? Any particular strategy for retaining and that profit and then kind of getting out? Because I think a lot of people, we run into these problems where it's twofold. So, you kind of are sitting there, your option pops up 30% in the first minute, you're like, oh wow, it's already up 30%. Well, let me wait for a nice round number. Let me wait for 50%. Let me wait for 100%. And then on the opposite side, you take it at 30% and then, or 100% and then it runs, 300%. So it's like, how do you find the place where you're comfortable and you walk away, knowing that did, I'm using finger quotes here, the right thing.
And again, this is what I want to say. Mindset's the most important thing, man. I think that there's, in my opinion, there's no such thing as cut too early, right? I got some new guys in my chat. We got on Google. A couple of these guys got out. They took 1,400. I'm seeing some comments. They're like, dude, I left 9K on the table, right? So the mindset is saying, you made money, man. You know how many people are on the opposite side of that Google trade? So just, accept it, log it, make some adjustments, come back to it and trade it up again. But just to answer your question, me personally, my goal is this is going to depend on the stock, right? So when I got into Google, I'm very bullish. The market's bullish. And the reason why I was bullish is because the same thing I put out on Netflix last week. Netflix beat earnings. It's not going anywhere. If it breaks this level, we have a straight shot to that level, right? So the same thing happened here at Google, and that's what I was trying to talk about in the spaces last night. So I'm bullish on the position. I'm bullish on the market. So I'm going to be able to let this trade run. So for me, I kind of don't want to cut out until I get to 50%, right? I might because I'm bullish on the market, I'm gonna put not a percentage based stop. I'm gonna put a structural based stop, meaning if Google closes below this level, I'm gonna hold until it closes below this level. This is the level I'm wrong, right? Let's say it's 2,000. If it's 2,000, I'm out. All right. So now I'm shooting for 3,000 price target. I'm not. This is not how I traded this today. I'm just giving numbers. You know what I mean? Just to explain it. But I'm shooting for 3,000. I'm in at 2,200. 2,000 is my stop. As long as it stays above 2,000, I'm staying in the trade because that's the risk I have accepted for the trade. Because the market's bullish, I'm bullish on this position. Everything in the sector is moving up higher. I see a lot order flow and relative volume. I'm going to try to let that trade run. So when I'm in a let that trade run mode, I'm going to try to cut 50% at 50%. I want that trade to get to 50%, and I'm going to cut it at 50%. That way, even if it comes back down against me, it can come back down to where I bought it at. It can go negative 12%. I'm still in the money. And because of that, when you get into a trade and the risk comes off of it, it's like there's this feeling of just relax. Like there's times when you get in a no risk trade, you just stop looking at the computer screen and go do something else. Talk to your wife, do whatever it may be, then come back. But if you know you can lose money, you're not leaving that chair, right? So for me, 50% versus 50%, right? That way I can hold it overnight. Now, if I'm in a classification of the market where it's sideways or really volatile, I'm scaling out quicker and I call it by quarters and I do it by percentage. So if I'm up 25%, I'm cutting 25%. I'm moving to stop the break even because I don't really trust the market. And if that comes back against me, I want to protect my capital. So there is definitely a time and a place to try to let your trades run versus when you should be scaling out just to protect yourself and just try to put numbers on the board.
Got it. Got it. All right, I'm getting a couple questions on some more complex strategies as well, so I might touch on those a little bit more. I just want to reiterate once more as well that this is just one of many spaces that myself and these other speakers are doing throughout the week, and you can catch us on them where we're going over different things. Last night we did technical analysis. I did a fundamental analysis one. This is options. I think we'll probably bring back more options ones just because more people are trading them, and if people are going to trade them, I'd rather they have the opportunity to have an education on them and understand because it's hard to just put ourselves through. It's really not something that's actually taught in school. I was a finance major not too long ago. I got a degree in finance. They did not teach us how to trade options. I'll tell you that.
That's right.
In school, that's something. Yeah, like they do not teach that. I learned how to trade options off of TikTok. So like there's clearly a problem here in the system. And with that being said, the one other thing I was going to say was, because I said this earlier and several people already DM me, was once again, if you want to make sure that you're seeing all these spaces, it's really difficult for me to put them, out there because I only get to do one reminder at a time. So I just have a free Google Calendar. It's public. There's hundreds of people on it. Nobody gets to see information. All that happens is you can toggle on and off just to see all my spaces on your calendar. And all you need to do is just send me your email, whether that's Gmail, Yahoo, your school email, especially if you're in school, send me your school email. Because you should be on this and you should be learning about these things. So go ahead and shoot that over to me in the DMs, and I will add you to the calendar after this so that you don't miss any spaces and you can continue to educate yourself. All right, now an interesting question on a little bit more of a complex strategy. So I'll throw this over to you exclusive. Maybe you do these, maybe you don't, but somebody asked, how can I improve getting filled on butterfly plays, especially when I'm trying to make an exit and take profits? And for anyone who's unfamiliar, a butterfly play is a bit more of a complex strategy where you're involving either 4 calls, 4 puts, or a combination. They're considered to be market neutral, and essentially these pay off when the underlying option does not move prior to the option expiration. But with any of these, I guess, strategies, it could apply to butterfly plays or some others. How can people, I guess, improve getting filled on these?
Yeah, so for the sake of learning and just transparency with our members, and that's also why I don't share option trades on Twitter. I stick to just simple calls and puts because it's the easiest to understand and it's the easiest to get good at. Butterflies and I think what you're referring to with the forward contracts is a condor. These strategies are harder to get filled because you're trying to get filled based on either the credit or debits on 4 different strikes or expirations. So of course it's going to be more difficult to get a fill because you're depending on what broker you use, it's automatically trying to calculate the middle price or the mark versus using a limit, which is going to be really difficult because the price is fluctuating so much between four different contracts. So, would I recommend, calendars, diagonals, butterflies, condors, yada, yada, yada? I would say stick with just the simple calls and puts because you have to think of trader psychology. There are a huge amount of influx on new retail traders, and they're going to do the basic option trading. So the calls and puts is one click, done. When you're doing a condor or a butterfly or a vertical, you're clicking, setting, clicking, setting, clicking, setting, clicking, setting. Not only does it take more time, but you're also limiting your profit, you're limiting your losses as well. But if you've been listening to my style, it's really not bent around, having a tight stop loss, in which case these more advanced options, whether you're approved for them on your broker or not, these advanced option trading techniques are to limit risk. So if you're not worried more about smaller gains and smaller losses, stick with the basic calls and puts because even a custom spread is a little bit better than doing these 3 to 4 option spreads. So yeah, personally, I'd recommend the basic stuff. But if you're good at it, then by all means, I know plenty of people who make really consistent money. But we talk every 3 4 months, and I say, oh yeah, cool. It took me about 3 hours to make that.
Yeah, okay, that's pretty fair. To stick with the ones that, especially the ones that you know and are used to. And I do the same. I've never traded any of these more complex strategies. Seems to be the people that I find that are just doing the best are not. They're simply just sticking with those typical calls and puts. Those work for them. They can get filled fast. They can get in at the prices that they want. They can get out at the prices that they want. So there's plenty to be said for those. Okay. Yeah, exclusive.
Yeah, and just to touch on, I got a DM about this. When I say the fills are more difficult too, that's that in these cases of diagonals, butterflies, and condors, etc. In these cases, you're more dependent on volume, and I don't like being dependent on volume. I like taking advantage of volume. So if you're in something where you have quadruple the amount of contracts, whether you're spending less money or not, you're reliant on 4 different strikes filling in order to get that credit or debit to fill. So you're just limiting profit potential, you're taking more time at it to trade, and you're also leaving yourself susceptible to the ability to fill the trade. So it's just that's 3 strikes for me. That's why I stick with just the simple basic calls and puts.
Got it. Nuts. You had mentioned earlier you had this other strategy. I think you mentioned it had a really high success rate for you. Do you mind reiterating what that was? I think it was a more complex trading strategy.
Yeah, yeah. And honestly, I'll be honest. I agree with what they're saying too. I've only done put and call credit spreads. I haven't really dove into anything else. And honestly, the reason why is I just I've done so well with just these, and I just didn't really need to. But yeah, basically, here's the simplest way I'm going to put it because I'm going to tell you I've read this stuff online, and they just make it so complex, and I really don't know why. Um, and the simplest way I'm going to put it is exactly like this, and I'm going to give examples. So for Google, if you expect Google to stay above, and I'm not just saying this is just an example. I'm not saying to do it or this is what I'm saying to do. Uh, Google, if you expect it to stay above 2,900 for Friday, okay, you would do October 29th date. You would do you would sell a 2,900 put, so you expect the price to stay above 2,900, and you'd complete that trade by buying a 2,890 put. So you sell the higher strike that you think it will not go under. So you're selling the 2,900 put and you're buying the 2,890 put to basically complete that trade. So if Google closes the week over 2,900, you will be 100% profit. And let's just say, I'm not looking at the premiums right now, but let's just say you get in for $1. So let's say you buy, one contract. And it's a $10 spread, so 2,900 to 2,800, $10. Sorry, 2,900 to 2,890, $10 spread. Each contract you buy is $1,000 of risk, and like I said, the probability of these trades working out is much higher. That's why the risk to profit is lower. I'm not saying this is a good trade because it isn't. Google went up 100 and whatever dollars today, and it could easily drop 50 tomorrow if it really wanted to. For example, if you wanted a safer trade, I'm just saying, for example, you would sell 2,800 puts, so you're getting $150 in the money of safety, and you're buying the 2,790 put. So the profit's going to be lower, but the probability, and you could even see the probability on these trades. It shows it on whichever broker you're using, whether it's Robinhood, whether it's E-Trade, it shows it. It'll say, like, let's just say 92% probability of winning. You'd sell the 2,800 put, you'd buy the 2,790 put, and if the Google closes over 2,800 by the end of the week, you make 100%, and you completed that trade for full profit. And like I said, you could do the same thing for capping the upside if you think a stock's going to stay under a certain level. So if you wanted to sell Google 3,000 calls and then buy Google 3,010 calls to close the to complete the trade, complete the spread, then if Google closes under 3,000 by the end of the week, you make full profit. And that's literally the most simplest way you're going to be taught this, truly. I've read online so many different things, and that's literally how I tell everyone. That's how I tell my friends, because I got them into spread trading, and it's just, that's literally going to be one of the simplest ways to explain it.
Awesome. Going to you, Exclusive.
Yeah, I just wanted to point out, so 15 minutes ago when we were talking about Amazon,
Oh yeah, I've been watching that.
that's a perfect example of when to enter an option trade and why you enter the option trade. So short term, we're looking at just the high of day, what's known as an open range break. So you see the break and then you see the back test. So around the 34.11.50 range, I bought 34.20 calls, which for Amazon is in the money because the stock can move 10, 15 points within a matter of 10 minutes. So that's why I'm saying look at Amazon. It's about to start moving. So that's like, that's in real time, so you can kind of understand the psychology that goes behind making an option trade. So, I got 34.20 calls, like I mentioned. So those were $6,000 a contract. It's the same trade that I took yesterday. The only difference is now, since I got stopped out after I took profit yesterday, I left one on the table. And as soon as it came back to profit, I just repeated the same exact trade. And it was at the same technical moment where you would have considered entering yesterday, but now that it's got the volume, now that it's got the deltas getting multiplied, the gammas multiplying the delta, and it may be affected a little bit more by the theta decay because time has passed since yesterday. The trade's still going to profit, and that's how you make a quick $1,000. We went from 60 to 70 within 15 minutes. I took my 17%. I'm rolling up, and profit's profit. That's the easiest $1,000 if somebody bought one contract. That's the easiest $1,000 they'll ever make trading an option.
Awesome. And I've gotten a lot of DMs about this. So this space is, I do believe at least, being recorded. I had chatted with one of my Wolf teammates about coming in here and recording this. So I think that they are in here. And after it's recorded, I'm going to do just a little bit of editing, and then I will post the recording onto my YouTube and Spotify. You can just search Wolf Financial on both platforms. You can see a ton of spaces. That's pretty much most of what I upload is recorded spaces on different topics. And I'll also make a post onto Twitter as well. So if you're following, you'll see that post on a Twitter later on, and I'll be sure to tag the speakers as well when I put that up, usually within a day or two of this being done. And with this information, I wouldn't say it's massively time sensitive. I think a lot of what's being stated can be used in the future as well. With that being said, we've run for about an hour and 20 minutes, so I'm going to move into just some closing remarks, just some information from the speakers. Also, once more, because a couple people have asked, that book that was mentioned was Trading in the Zone, so you can check that out. Juicy posted a link somewhere in the comments on the post that I put out about what questions people have about trading options, and that's on Amazon, so you'll be able to get that there. But I'm sure there's a lot of other information that you can get online in many different resources, and following these speakers is going to be one of your best ways as well, since they're consistently posting, and I think all their DMs are open. So they're really gracious people within the DM. So if you have a good question and you reach out with that, I can't see why they wouldn't get back to you. Um, and they also have like Discords and everything like that, so you can go ahead and check those out as well. Some of them paid. I'm not sure if any of them have unpaid, but perhaps. With that being said, let's move into just some closing remarks and anything else you think would be important for someone to know about this industry of option trading, and just anything else on your horizon, or if there's any names you're watching for the rest of the day. Knox, you want to go first?
Yeah. I mean, I'm basically kind of done for the day. I definitely would keep on watch Google and Amazon because I was watching it too when it was at around 3408. Google, Amazon. Watch how, if anyone watches the SPX futures, which is ES, watch how it reacts to 45.76. Would be the opening range breakout, and I think that's it for me. I mean, I completed all my trades in the morning, so don't really want to overtrade. That's a very bad habit that many people have, including myself sometimes. I've definitely gotten rid of it, but it comes back here and there. Other than that, I mean, that's where I'm at.
Perfect. And one of the topics, I think we are going to do another option trading space. One of the topics we'll do on the next one, I just don't want to get too pointed now, is going to be selling the other side. So when to sell calls, when to sell puts. We touched very briefly on it, but just like you can buy, you can also sell these and collect premium on them. And it just works basically the opposite way. So if, for example, you were looking at a stock and you are believing that it is not going to go up, so you are bearish on it, or you think it's going to stay flat, you could go ahead and sell calls on that, collect premium, and the opposite way with puts. But one thing I'll be really, really emphasized is you don't want to just be doing what's called naked selling, which means you don't want to be selling calls on something but you don't have the underlying asset. So, for example, if you had 10 shares of, I don't know, Penn National Gaming, and you went ahead and sold, a call on it, well, a call covers 100 shares, so you are uncovered. So in this example, your downside is pretty much unlimited, as the stock could have a massive run up, and then you would have to buy the stock at that much lower, at that higher price, and sell to somebody at much lower. So you want to be careful from that perspective. With that being said, exclusive, would you like to go next?
Yeah, sure. So for the rest of the day, I just rolled up my 3420 calls. I just bought some 3500s. So same thing. I'm just expressing it in real time. So we're taking advantage of swings. We're using profits to day trade, and we're rolling up profits to take the next trade up. So we're locking in those gains on the previous trade. Like I said, if you got $1,000 from one contract, if you bought 10, you got 10 grand. You can roll up to the 3,500 contracts, and those are only $3,700. Well, when I bought them, they were $3,700, and you can use those profits to get 3 contracts, and you're 100% risk free. So, guys, it's really not rocket science. People make it way more difficult than it needs to be. It's just a matter of being able to trade when you can pay attention to it, more than anything. Because I think that's the number one, or actually that's the number 2 factor that kills a trade, is not being attentive. So I have people that have day jobs that are trying to trade, and it can work some of the time, but most of the time it can't physically work because you have to be able to manage your trades. Unless you're going to the stop loss thing, which I'm not really a fan of. Other than Amazon, GM had a pretty good bounce. There's a lot of names. Microsoft, Google, Spotify, AMD, Snow, Beyond Meat, Chipotle, Nokia, Home Depot, Nvidia, Chewy, Futu, CRM. I mean, I've got a lot of trades on the table right now, so it'd take me a while to go through them.
Awesome. Well, I appreciate the transparency there with sharing your trade, and yeah, great point with how it can be really tough for people who aren't doing this full time. You don't want to have to, walk away. That's where you can get caught up in the trickiness of getting stopped out if you're using those, or if you don't have a stop, taking a big loss if you're not there kind of watching, and also you're not going to be able to sometimes grab that profit if you see a spike. So great points there. And Juicy?
Nah, I mean, I just want to echo, this has been great. I hope this has helped. I'm gonna do something a little unorthodox here on my closing. I just want to say that just like anything, um, it's going to take practice for you to get good. You're not going to be a seven-figure trader in a week, in a year. Everybody comes into this game and they want to make money today or tomorrow. And in theory, this is a journey. Your goal shouldn't be to make a seven-figure profit tomorrow. Your goal is to become a break-even trader, then become a slightly green trader, and then become an amazing trader. And that takes time, practice, and a lot of work. Like a lot of people don't realize is that as traders, we do so much outside of the market. You just see us pushing buttons and throwing a gain or a loss on Twitter, but you didn't see that. I logged everything. Every button I pushed, I logged. I sat here and reviewed it every day. At the end of the week, I went through every trade. I called my psychologist to talk about my trading problems that I had during the week. At the month, I have a weekly review. I'm coaching. I'm constantly looking to improve my process and become better. And I think that's the biggest reason why 90% of traders fail, because they had the wrong outlook on trading. So again, focus on the outlook, especially if you're new, and know that you're in it for a long run. And just know that there's a time and a place to be trading, and it's okay for you to take breaks and go in simulation, man. I see too many people just giving up, man. Like, so just stick with it, and over time you'll become a better trader.
Yeah, 100%. These can be used for the long haul. I totally agree with you. Um, And also, you don't have to play like weeklies or anything like that. Like a lot of people, we didn't even get into this, but the time horizon that you can play on options, you can do things like leaps, which is going to be, a year out or kind of into the next year. That way you don't get so killed by theta. There's a lot of different ways to play this. If you look here, I'll reference one of the most successful option traders of our time, Nancy Pelosi. She loves taking leaps. If you look at her positions, she's going way out on these Nvidia and Apple and other calls, and it's working great for her over time. So just something to keep in mind is you don't have to play super short term, even though you look at it and be like, oh, well, I only have, a couple $100 right now, so I'm going to buy this in, out of the money weekly. Your risk to reward can be severely thrown off by that because the risk just escalates so far. Exclusive?
Yeah, I wanted to reiterate, I got a DM about this. So the setup for the trade is posted on the Twitter. So we posted the chart for the setup at 111 for where it's currently at. But if you search our profile, you can scroll or use the search bar. Just type the ticker and then use our Twitter handle, and then you can search by ticker and look at the charts before that. But no, so what this setup was is really just a back test of the downtrend break from last week. So it really is just a matter of reclaiming moving averages, and on that break is when a lot of people, like myself, are waiting for a technical, and they're going to have orders set and their plans are in place. And that goes back to what we were talking about at the beginning, is going into an option trade with a plan before everyone finds out or catches on. Because, once you get into those trades before a lot of people, that's when you rely on the FOMO to just make even more money for your position that's already in profit. So, that's why, we saw the momentum that we saw in Amazon. There's a reason why a lot of people are trading the same things, is because there's technical traders, there's psychological traders, there's rookies, there's pros, there's institutions. So yeah, just have a plan, set it up, and follow it without faltering.
Dude, how about those Amazons that you literally just said? What was it, a couple minutes ago? You said the 3500s, was it?
Yep.
And how much are those up since you said that?
When I bought them, the premium was a little bit lower than what it is right now. So you'd be chasing a little bit, but I bought them at 3,700. And right now they're at 39.30. So, and that's the
Wow.
that's the last ones that were been able to be sold. So you know, within a matter of an hour, you know, you can make your entire day, week, month, however much your account size is. But you know, those 3420s, those have went to 75 from, you know, when we were first talking about Amazon. So it's just a matter of having a plan and sticking to a plan. It's really how you succeed as an option trader.
100%. And so I do have a few more questions in the DMs, but they're mostly around just, what does it mean to buy? What does it mean to sell? Investopedia is a great resource for this. They break it down super well. YouTube as well. This was trying to take some live questions from the audience, give some initial overview. Again, this was recorded, so I'll have it out onto my YouTube and Spotify and Apple Music and all those other platforms. It just auto distributes. So you'll be able to kind of listen back if you wanted to listen to the credit spread strategy or what book you should read and all that. You'll be able to go through and get it. As for the rest of today, if you take a look at my pinned tweet, it's always a master schedule for the week that I put out. I spent like 4 hours this weekend DMing people and creating this graphic and everything, but you can see today's pretty packed. So at 3 p.m. EST in an hour and a half, I'll be on with The Street. With the co-host will be Stock Market News and Catherine Ross. I know we're going to be discussing some cryptocurrencies on there, some other some earnings, some macro talk, some stuff like that at 7 p.m. EST. I'm going to have the Wolf of Weed Street on, and as well as Brad from Stock Market Nerds, Zach Sokol, Toby, and we're going to be discussing how to invest in the cannabis industry. And then at 8:30 p.m. EST, if anybody else has not seen this yet today, the coin SHIB has been cruising. I think it's up like 50% today or something like that. So we're just going to do a space with everything you need to know about SHIB, so just so you can understand that. And I'll be co-hosting with Vegas and the Blonde Broker, and then we'll have a couple speakers that are actually Now Payments and Shopping.io that I believe accept SHIB, which is like an interesting thing to hear from there. So just keep a look at it. This is, I guess I hosted about an hour and a half today. I hosted for 4 or 5 hours yesterday, and I'll probably do another few hours today. So excited to have everybody that has followed during this and has joined up. This is, I think, one of the best ways. I'm very grateful that Twitter Spaces became a thing, because for me, I'm not the educator here. I'm just pelting people with questions, as you heard throughout this. It's a great opportunity for myself, and I hope that everybody does go ahead and takes advantage by both following my speakers and then following the Wolfpack, so that you can be a part of all these spaces. And again, I will try to work in as many questions from the audience as possible, whenever possible, and we talk over everything from individual names to large topics and everything in between. So with that being said, wishing everybody a great rest of their afternoon on this beautiful Wednesday. And if you are interested in some macro talk, some crypto, some earnings, I will see you in an hour and a half back on Spaces. Take care, y'all. Have a good one.